If you're studying accounting and finance, you might have come across the word current ratio. Now, if you're wondering what it means, probably you've seen it appearing on the balance sheet, or now, as we name it, Statement of Financial Position. Indeed, there are two sections on the Statement of Financial Position, known as current assets and current liabilities. Current assets normally comprise of number 1, inventory, number 2, receivables, number 3, cash at bank. Current liabilities usually comprises of trade payables. In other words, balance which are due for payment to suppliers of the business. It makes practical business sense that the amount to be paid to suppliers should come from current assets. In other words, current assets should be used effectively to pay for current liabilities. Therefore, the business should have sufficient current assets to cover current liabilities. This can be measured by the current ratio, current assets divided by current liabilities. The strength of the ratio generally varies from industry to industry. However, a ratio of 2:1 is generally viewed as healthy for the business. Please like and share the video. My name is Shaktee Ramtohul and I'm a member of the ACCA. Visit the link in the description below for my ACCA tutorials.